Welcome to FP&A and Finance Insights. I'm Jack Alexander, and our topic in this video is the review and evaluation of financial projections. A little bit about the series here. I created this channel with the objective of sharing nearly 5 decades of experience as a CFO, writing 3 books on finance and FP&A, and teaching across several MBA programs. The sessions are short and focused on important topics. We've got a variety of playlists included there that you can visit and check out. And importantly, many of the topics, illustrations, and models are based on my latest book, Financial Management, the upper right-hand corner. And that book comes with an accompanying website that has all of the Excel models and dashboards and analysis that we'll be looking at today and in the other videos. So today, we're within the playlist Planning and Forecasting Business Performance. You see the other titles. Today we're going to talk about the important subject of reviewing financial projections. And we're going to talk about the responsibility for the review and approval of projections, best practices, and I'm breaking this into a fundamental analysis and a technical analysis, just as analysts look at stocks. And then we're going to talk about setting expectations and then recap. So in terms of evaluating financial projections, senior financial and operating executives must evaluate, in many cases, approve formal projections and plans. And this even goes right up to the board of directors levels and occasionally even to shareholders. And so as you rise through the organization, your role generally shifts from being involved in the detailed preparation and putting together the projections to evaluating them, and it takes a different skill set. We have to recognize that all projections include dozens of assumptions, and so as a reviewer, we need to be able to think about and identify and evaluate those critical assumptions that are being made in the plan, and also think about what events may occur that could impact the plan favorably or unfavorably. And again, we'll talk about the 2 sets of best practices. So on the subject of identifying and testing critical assumptions, every projection, no matter how complex, of any type, is about the future and requires us making assumptions about an uncertain future. So critical assumptions should be identified, evaluated, and even flexed. That is, we should test the sensitivity of the outcome on the plan of any change in large critical assumptions. Managers should test the sensitivity and the decision criteria. For example, if it's a capital investment project and we have a set of projections supporting that decision, we should understand how sensitive the decision criteria are to any changes in critical assumptions. And we should monitor these assumptions once we identify them. As part of the management process, we can monitor these and understand what the impact on the total projections and plan might be and manage and react accordingly. So here's a list of key business drivers. It's a generic list. This is from the book, but it presents a recap of questions really that should be asked on any comprehensive plan. And this would be underneath an annual plan or a strategic plan or an M&A activity, for example. So revenue is always one of the most critical drivers, and we should do a lot of testing and exploring of that as reviewers. We should understand how the projections relate to assumptions about how fast our market is growing. We should look at our market share, and do we expect it to increase or decrease? And by the way, if it's increasing, who are we taking share from? Will we be able to increase prices? What new products and services will be introduced in this plan by us and also by our competitors that could have a negative impact? What products or services that we have might post declining revenues in the future due to the maturing life cycle or competitive inroads? And what are our assumptions about the general economy and interest rates? Costs and expenses, inflation, key raw materials, labor and related expenses, other key variable drivers such as employee health care, what increases to headcount will be required to execute the plan, and are they properly treated in the plan? Asset levels, we should understand if there's high growth, what level of working capital would be required to support this plan? And do we need to increase capacity, add manufacturing floor space or another factory to achieve these sales? And then, of course, it all boils down to whether we need financing, additional financing, and what changes to our cost of capital may occur. For new products and programs, how do these projections compare to similar projects in the past? What are the 5 most critical assumptions? How will we monitor them? And what will we do if our assumptions prove to be different than the actual reality? Let me see your execution plan. Very important point as reviewers. We should make sure that any projections are supported by detailed execution plans. Another analysis we can do is ask for the identification and evaluation of events that may occur that would have an upside or a downside impact on our plan. And some events have a binary result on our financial results. You're either going to win a contract or you're not going to. And so those revenues and profits are going to be there or they're not going to be there. So I like to use an analysis as shown here where we might tease out the 2 or 3 most significant upside potential events and also the same number of downside potential events. And once identifying them, we can think about identifying the leading indicators, what will give us the most time to react when we know that things are trending in a certain direction. What's the event criteria? That is the trigger event where we know it's happening and we should take action. What's the potential impact on our plan? What's the probability of it occurring? And very importantly, again, it's not just about the numbers. What are the management actions that we can identify now that should be taken if that upside or downside materializes? And as we look across all of these with the probability weighting, we can see whether there's more upside or downside exposure in the plan. And in this case, it's negative 4.92 million, which might suggest that all in all, our plan is a bit aggressive and we may want to have another look at this. So again, the important issue here is to identify the upside and downside risks and manage them, but also to take action, identify the actions that might be taken to mitigate any of these downside risks and to capitalize on the upside potentials. Know the planner and circumstances. We'll call this the underlying soft issues. There's always a story behind the numbers, and we can look at this in a couple different ways. One is if we have numbers or plans, projections from this individual in the past, we can look at their history of actual performance versus past projections. And I will tell you from experience that some managers always meet or exceed their plans or projections, and others generally have difficulty doing that. And there's 2 pieces of this. One is the quality of the projections and the level of optimism or pessimism, but also their ability to execute. And generally, those that consistently fall short don't survive well or move to another role within the organization. I mentioned bias. There is a huge impact on projections of bias, and it's human nature to have certain biases. Are we optimistic or conservative? Are we affected by recent events? By the way, what's at stake with this plan or projection? Does this projection, maybe it's the update of a new product introduction or the start of a new business, and so failure to present this in a favorable light might result in cancellation or termination of the project or a significant redirection. If it's an issue where the management team may be perceived as not performing to expectations, people's jobs could be involved. And again, that might create a tendency to put more aggressive numbers out there than less aggressive ones. Very important issue is to think about the interaction with performance assessment and incentives. We talked about the job performance if somebody was struggling, perhaps, but also many incentive plans are based off the plan, and so that would have a tendency to drive people to create more conservative plans because the upside for their incentives that they could earn would be increased with a more conservative plan. So very, very important to understand the underlying dynamics and factors. So on to the technical analysis, if you will, of financial projections. We got a couple different charts here. We can look at the projections and we can look at projections over time and draw some conclusions about the current projections that we're looking at. In the upper left, this is a trend that I like to look at, a graph that I like to look at, the actual versus budget, and we also overlay the rest of year forecast on there. So it's a cumulative revenue, let's say, over the year, and you can see that the blue line here indicates that we are falling short of the planned results on a year-to-date basis through most of the year. However, the red line, the forecast, projects that we're going to close that gap in the rest of the year. So that opens up and allows us to ask a number of questions of why we're falling short of the plan year to date, but plan to exceed the plan rest of year, and would be very interested in the answers to those questions. In terms of longer term projections on the lower left, this is an example of what's often called the hockey stick. The blue line is a trend of recent performance. You can see it's flat to declining. But the long-term projections, the strategic plan in red, show a significant change in direction here, and we're all of a sudden going to grow at a pretty significant rate. Whereas if I were to extrapolate recent performance, it would show that we would continue to slowly decline. A lot of questions can be asked around that and understanding what is the impetus for the kink in that curve. On the right-hand side is an analysis of monthly forecast history, and what it really shows us here allows us to understand what happens to a person's view of the individual quarter forecasts as they go throughout the year and also the total year. And you can go through the numbers and draw your own conclusions, but in many cases, this particular organization isn't recognizing that they're going to decrease the forecast until they really come up to the end of the period. And the graph on the bottom shows that the total year forecast perhaps was aggressive or optimistic, and they reduced it in the middle of the year and then had to reduce it again towards the end of the year. And of course, the question is, why weren't there leading indicators of performance, or why didn't they take a more conservative approach? Why didn't they see that this was inevitably going to happen? Another way to achieve this would be looking at quarterly revenues versus a forecast range. So the orange column is the range of forecasts. I encourage the use of ranges because it just underscores the fact that forecasting is not precise, and there are a lot of pluses and minuses that go into developing any projection. And so the round circle is where the quarter actually wound up. So this is commonly used by publicly traded companies where they will share with investors a range of revenue and a range of earnings per share, for example. And so as we look at this, we can observe some patterns about potential biases that are in here. So the first 3 quarters that are shown there, we either met or fell short by a significant amount of the revenue forecast. In the other quarters, beginning in the center there, we began to exceed forecast, and then we had a string of meeting and then exceeding the forecast by a healthy margin. So this may identify certain biases or process issues that were fixed somewhere along the line, but this would give me great comfort in accepting the forecast and perhaps even requesting an increase or evaluating for a potential increase based on the last 4 quarters presented. We can use an old stat tool, probability analysis, to come up with the expected value of revenue I'm going to just illustrate a very, very simple case here. And I've used this to test and push back on sales and general managers. What we do is we take the base plan, in this case 115 million of revenue, and then we look at a couple of upside levels. We went in 5 million increments here, up to 125 million and down to 105 million. And I simply ask the responsible manager to assess probabilities of achieving each of those individual numbers. And in many cases, it falls out like this. And if I do a probable outcome, it comes to 112,500. Remember that our base case is 115. So how do we feel about the base case in light of that? It might suggest that the base case is aggressive, since the expected value, the weighting of these probabilities falls lower. But again, the value's in the thinking, not the math. So we could try and understand what might give rise to those downsides. How could we address them? Or why isn't the upsides more balanced in terms of coming up with a most probable plan projection? Sensitivity analysis is very important. And again, in preparing plans, but especially in reviewing and evaluating them, we want to understand how much the plan could be impacted by changes in key assumptions. So in this case, we're doing an illustration of what would happen to projected profits based on changes in the price of oil. And this shows a fairly dramatic impact on the organization's profit, and this provides insight into the dynamics of the projections and the importance, in this case, of oil, but you can do this for any assumption, of course. And so really the management action that's implied here is to understand that this can occur. There are possible outcomes which include all of those, and what actions can be taken to minimize the impact. Are there hedging strategies, forward contracts, collars, other things that we can do, or can we take other management actions to minimize the impact? And by the way, it winds up just being helpful to know that this is the range of potential outcomes, and to be sensitive to the fact that we need to monitor and track the price of oil over the plan horizon. Scenario analysis is another very useful tool, and I advocate using this and incorporating it into all plan and projections. And so the templates that we develop for people that are responsible for planning process should at least contemplate different scenarios. So a scenario is different than sensitivity. Sensitivity, we were looking at the impact on the plan of a change in one variable. In scenario analysis, we're going to look at the effect of an event or a change in circumstances, for example, a recession, that would require reevaluation of several different variables. A recession, for example, might put price pressure on our products, might also lower demands, might lower interest rates, might put less pressure on upward momentum for labor rates, might have lower employee turnover, might have an impact on commodity pricing. So in scenario analysis, we're going to try and rethink our plan based on the story of a recession, and think in the ways that it's going to change the plan in total. And then we can present, as the chart on the right shows, different scenarios and what the impact on the plan would be. It's critical in today's uncertain and fast-changing environment. Another critical thing to think about is we don't just want to develop plans and projections for the sake of the financials. We want to make sure that we are developing a robust management process. As General Eisenhower said here, in preparing for battle, I've always found that plans are useless, but planning is indispensable. And that indispensable value lies in the critical thinking and analysis and testing that goes into developing the plan. So we don't want our plan just to be the contents of a binder with financials printed out around that. We want to make sure our planning activities facilitate that situational analysis, identify and reflect key drivers, and that we encourage critical thinking and help to develop a game plan for a path forward and an ability to execute the mission. Setting expectations. As someone who reviews and evaluates plans, it is very important for the organization and the process owner to set expectations clearly. So what are we looking for here in terms of confidence levels of the plan? And also, what do we want that would be that thought-provoking, analytical analysis, situation analysis? We want to build those forms. We want to build that process right into our planning activities. In terms of desired confidence levels, some organizations say the plan should be 50-50, or a given estimate should be a 50-50. That is, half of the time we would exceed it, half of the time we wouldn't. 80-20 would be a much higher confidence level. Could interpret that as being 8 out of 10 times we would make or exceed the forecast. Some would use words like, we want them to be conservative, we want them to be most probable, we want it to be best case. Most businesses and senior executives would want to know what the most probable was, and then they perhaps would want to have a view on a scenario basis of what could be the best possible outcome and what is a downside scenario as well. So very important that those expectations be set very clearly. So in summary, as we progress through our finance careers and operational executive tracks as well, we'll spend more time reviewing than preparing plans. Reviewing and evaluating projections should include both fundamental and technical analysis, and we really have to understand the soft issues and the things that affect human nature that might be influencing whether this plan is aggressive or conservative, achievable or unlikely to be achieved. Single point projections have limited value. I always encourage adding things like scenario planning and sensitivity analysis. We want to, as reviewers, understand the dynamics of the plan. We just don't want to see the plan in one scenario of numbers. Additional best practices are included in projections, capital investment decisions, and M&A playlists specifically for those areas. And again, the objective should be to reveal the underlying dynamics of the projection. And we really want to make sure that we increase the chances of the organization in their ability to achieve the plan and execute to the plan, achieving the projected results. So thanks for your time. I hope you found it of value. Please like the video if you did, and subscribe to the channel. And we'll be presenting and uploading more videos over the next several weeks.